Limited companies of all sizes can distribute their profits to shareholders as dividends. In this video, we'll be explaining what dividends are, how they are taxed, and how to properly account for them in 24-25 tax year. So once again, welcome to my channel, Finance for Founders. So what are dividends? If a limited company has made a profit, it is free to distribute these funds to its shareholders. This is the money the company has remaining after paying all business expenses and liabilities, including any outstanding taxes, such as corporation tax and your VAT. This retained profit may have been accumulated over time, and any excess profit not distributed as dividends simply remains in the company's bank account. Individuals don't pay national insurance contributions on dividends, whereas they do on salaries. Dividends are distributed to shareholders according to the percentage of the company shares owed. If you have half the company shares, you will receive 50% of each dividend distributed. So how to calculate the tax payable on dividends? You pay any tax owed on dividend income via self-assessment. Any tax due should be paid by the end of January the following year. Taxes applied to dividend income as follows. In 2024-25 tax year, a £500 dividend allowance is also provided, which means that the first £500 of dividends are not taxable. However, this allowance does not reduce the total income figure upon which you are taxed. HMRC taxes dividend income after all income sources have already been taxed. For example, your salary and other relevant income from savings or even investments. So your dividends will fall into one or more of the tax bands after your previous allowance and other sources of income have been taxed. Dividend tax example, so 9,100 and dividends of 41,000. Here are the steps to calculate the dividends tax owed during 24-25 for a company owner that is paid a salary of £9,000 and drawing down the rest of the basic through dividends of 41,000. This combination of salary and dividends avoids the higher rate tax band. The first £9,000 of income is tax-free within the 12,500 personal allowance, and the next 3,400 dividends is tax-free. The next 500 is covered by the dividends allowance, but still uses up to £500 of the basic tax band. The next 7,000 of dividends are taxed at the basic dividend rate, which is 8.75%, which is £3,255. So in this example, the total dividend tax payable is £3,255. The next one is a combination of 12,000 and 37,000. So here are the steps to calculate the dividends tax owed during 24-25. For a company owner paid a salary of £12,000 and £37,000 in dividends. This combination of salary and dividend avoids the higher rate tax band altogether. The first £12,500 of income is tax-free. The first £500 of dividends is tax-free. And the next £37,000 of dividends are taxed at the basic dividend rate of 8.75%, which is £3,255 in taxes. In this example, the total dividend tax payable is £3,255. Now, the next example is £12,000 and £50,000 dividends. Here are the steps to calculate the dividends tax owed during 24-25 for a company owner paid £12,500 and £50,000 in dividends. The first £12,500 income is tax-free within the personal allowance. The first £500 of dividends is tax-free, which is the dividend allowance. And the next £37,000 of dividends is taxed at the basic dividend rate of 8.75%, which is equals to £3,250. The remaining £12,300 are taxed at the higher rate band, which is 33.75, and that's about £4,000 or so. So in this example, the tax dividend payable So if you want to declare a dividend, the company's directors must hold a board meeting to agree on the distribution. You must also keep the meetings of the minutes in your company records, even if you are a sole director. the dividend vouchers for shareholders. The directors must provide each shareholder with a dividend voucher along the limited company's paperwork. An electronic voucher, which is attached by email or electronically, could be generated by accounting softwares or so. It's perfectly acceptable these days if shareholders have previously agreed upon it. The vouchers should include the dates, the company's name, the name and address of the recipients, the total number of shares owned by the shareholder, and the total dividends payable to the shareholder, and also the director's signature. You must maintain the correct paperwork, including paperwork of board meeting minutes, as you may need to produce them if you are selected for a HMRC investigation. So how often should you declare dividends? Accountants often suggest processing dividend payments quarterly for easier record keeping, but there are no rules that determining how often dividends should actually be distributed. But it is crucial to remember that all dividend distributions must be legal. This means that the company has sufficient retained profits to cover them. Otherwise, they will be classified as illegal or ultra vires, and HMRC penalties could be imposed on your company. So dividends and tax planning. So limited company owners have the advantage of being able to determine the timing and the amount of dividend payments. The flexibility can aid in tax planning, such as delaying the distribution of profits until a year when you are expected to earn less than normal. Additionally, if you split ownership of your company with a spouse who has no other source of income or modest earnings, you can take advantage of their tax allowance and pay less higher rate tax as a couple. So what is dividend waiver? What is a dividend waiver? One or more shareholders may waive their rights to receive a dividend, so a dividend is distributed to some but not all shareholders. Take great care when using a dividend waiver. If this is not done for genuine commercial reasons, such as ensuring that the company retains sufficient capital after the distribution, you may attract attention of HMRC. And IR35 and dividends. If your contract work is caught by IR35, you would have to draw down the bulk of your company's income as a deemed salary after allowing for a fixed 5% administration allowance for the cost of running the company. But please note that you can only claim this allowance from April 2021 onwards if you are contracting with a small private client. You must also pay full PAYE income tax and NIC on this deemed salary at the same rate permanent employees also pay. So if you work as a limited contractor, you make IR35 compliance a key priority, as the financial consequences of being caught are significant.